What if I told you that one small financial habit, something you do every single month, is silently destroying your credit score? Most people have no idea. They check their score one day and suddenly it's dropped 80 points. No warning, no explanation, just gone. Your credit score controls your entire financial life. It decides whether you can buy a home, get a car loan, rent an apartment, or even land your dream job. A bad credit score can cost you thousands, sometimes hundreds of thousands of dollars over your lifetime. And the worst part? Most people are making these mistakes right now without even knowing it. Today, I'm going to show you the 7 biggest mistakes that destroy your credit score, and more importantly, exactly how to fix them. Stay until the end because mistake number 7 is the one almost nobody talks about, but it could be the most dangerous one of all. Let's get into it. Welcome back to Money Science ARs, where we break down the science of money so you can build real wealth. If you're new here, hit that subscribe button and ring the bell so you never miss a video. Now, let's talk about your credit score. Mistake number 1, missing payments, the #1 credit killer. This one sounds obvious, but you'd be shocked how many people fall into this trap. Payment history makes up 35% of your credit score. That's more than any other factor. Just one missed payment can drop your score by up to 100 points, and that damage stays on your credit report for 7 years. Here's the sneaky part. It's not always the big bills people forget, it's the small ones. A $12 streaming subscription, a utility bill you thought auto-paid, a medical copay you forgot about. These tiny debts can go to collections and wreck your score just as badly as a missed mortgage payment. Pro tip: set up automatic minimum payments on every credit account. Even if you can't pay the full balance, never miss the minimum. Use calendar reminders or a budgeting app like Mint or YNAB as a backup. Mistake number 2, maxing out your credit cards. Even if you pay on time, how much of your available credit you're using, called your credit utilization ratio, makes up 30% of your score. The golden rule: keep your utilization below 30%. If you have a card with a $5,000 limit, never carry more than $500 on it at a time. Ideally, you want to stay under 10% for the best possible score. Here's something most people don't know. Credit card companies report your balance to the credit bureaus once a month, usually on your statement closing date. So even if you pay your card off in full, if your balance was high on that reporting date, your score still takes a hit. This trips up a lot of smart, financially responsible people. Pro tip: pay down your balance before the statement closing date, not just before the due date. This is the move that separates the 750 score people from the 800 score people. Mistake number 3, closing old credit cards. This one feels counterintuitive. You pay off a card, you don't use it anymore, so you close it. Makes sense, right? Wrong. Closing old accounts destroys your credit in 2 ways. First, it reduces your total available credit, which spikes your utilization ratio overnight. Second, it shortens your credit history, which makes up 15% of your score. Credit bureaus reward age. A 10-year-old account tells lenders you've been managing credit responsibly for a decade. When you close it, that history eventually disappears from your report. I see this mistake all the time when people are trying to clean up their finances. They pay everything off, close all the cards, and then wonder why their score went down. Pro tip: keep old accounts open. If you're worried about overspending, just cut up the physical card or lock it in a drawer. Use it once every 6 months for a small purchase to keep it active and pay it off immediately. Mistake number 4, applying for too much credit at once. Every time you apply for a new credit card, a car loan, or a personal loan, the lender does what's called a hard inquiry on your credit report. Each hard inquiry can drop your score by 5 to 10 points. Now, 5 points doesn't sound like much, but imagine you applied for 3 credit cards, financed a new car, and opened a store credit account, all in the same year. That's potentially 5 hard inquiries. Suddenly you're down 25 to 50 points for no reason. Lenders also see a flood of applications as a red flag. It signals financial desperation, and it makes you look like a risky borrower, even if you're not. There's one exception: mortgage and auto loan shopping. If multiple lenders check your credit within a 14 to 45-day window, the bureaus count it as one single inquiry because they know you're rate shopping. Pro tip: Space out your credit applications by at least 6 months. Before applying for any new credit, ask yourself, do I really need this right now? Your future self and your score will thank you. Mistake number 5, ignoring errors on your credit report. Here's a stat that should terrify you. According to the FTC, 1 in 5 Americans has an error on their credit report. That's 20% of people being penalized for something that isn't even their fault. These errors can include accounts that don't belong to you, late payments that were reported incorrectly, debts that have already been paid showing as open, wrong personal information linking you to someone else's debt, or accounts from identity theft. And here's the kicker. The credit bureaus aren't going to fix these errors for you. You have to dispute them. If you never look at your report, these mistakes just sit there year after year, dragging your score down. Pro tip: pull your free credit report every year from annualcreditreport.com. That's the official government-authorized site. Review every line. If you find an error, file a dispute directly with the credit bureau. By law, they have 30 days to investigate and respond. Mistake number 6, only having one type of credit. Credit scoring models reward diversity. Your credit mix, the variety of account types you have, makes up 10% of your score. That might sound small, but at higher score ranges, every point matters. Lenders want to see that you can responsibly manage different types of credit. Revolving credit like credit cards, installment loans like car payments or student loans, and open accounts like charge cards. If you only have credit cards, your score is limited. Same if you only have one student loan. A well-rounded credit profile with both revolving and installment credit signals to lenders that you're a financially sophisticated borrower. You don't need to go take out a bunch of loans to fix this, but if you've been thinking about a credit builder loan or a small personal loan, know that it could actually help your score in the long run. Pro tip: a credit builder loan from a local credit union is one of the safest ways to add installment credit to your profile. You make fixed monthly payments, and at the end, you get the money back. It's a win-win. Mistake number 7, letting accounts go to collections without knowing. I saved the sneakiest one for last, and this is the one that genuinely shocks people. A collection account can appear on your credit report from a debt you didn't even know you had. Old medical bills, a final utility bill from an apartment you moved out of years ago, a gym membership you thought you canceled, a toll violation, a library fine. These small amounts get sold to debt collectors, who then report them to the credit bureaus. And just like that, your excellent 780 score drops to a 640, over a $47 gym fee. The damage from a collection stays on your report for 7 years. Even if you pay it off, the record doesn't disappear immediately, though newer scoring models like FICO 9 and VantageScore 4.0 ignore paid collections. Here's another twist. Medical debt rules have recently changed. As of 2023, medical collections under $500 are no longer included in credit reports from the 3 major bureaus, but that doesn't mean you're off the hook for everything medical. The solution is simple, but requires vigilance. Monitor your credit regularly. Services like Credit Karma, Experience Free Tier, or even your bank's built-in credit monitoring will alert you immediately when something new appears on your report. Set up real-time alerts on your credit. The moment a new account, inquiry, or collection hits your report, you want to know. The faster you catch it, the more options you have to dispute or resolve it before it compounds. Before I wrap up, here's one bonus strategy that can dramatically accelerate your score. Ask to become an authorized user on a family member's or trusted friend's old, low-balance credit card. You don't even need to use the card. Their payment history and low utilization get added to your credit report, and your score can jump 20 to 50 points almost immediately. This is called credit piggybacking, and it's completely legal. Banks do it. Financial advisors recommend it, and it's one of the fastest legitimate ways to build credit, especially if you're just starting out. Let's do a quick recap. The 7 mistakes that destroy your credit score are: Number 1, missing payments. Set up autopay today. Number 2, maxing out your credit cards. Stay under 30% utilization, ideally under 10%. Number 3, closing old accounts. Keep them open. The history is gold. Number 4, applying for too much credit at once. Slow down and be strategic. Number 5, ignoring errors on your report. Check it every year. Dispute anything wrong. Number 6, having only one type of credit. Diversify to signal financial maturity. Number 7, unknown collections. Monitor your credit in real time. Your credit score isn't just a number, it's a financial tool. And like any tool, it's only powerful when you use it correctly. If this video helped you, drop a like. It tells the algorithm this content is worth sharing, and it helps other people find us. And if you want to learn more about building real wealth, subscribe to Money Science AR because we have a lot more coming. I'll see you in the next one. Stay smart, stay wealthy.